Hello everyone, welcome to this channel. My name is Ruben and today I want to give you an update on LendingClub. The company is currently firing on all cylinders and shot up as much as 30% this week after another terrific quarter of earnings results. The digital marketplace bank is currently trading at $46 US. It has a market cap of 4.5 billion and compared to last year, LendingClub is up more than 10 times and I think that there is still growth left for this company. The stock is currently held in ARK Invest's ETF ARK-F. LendingClub has definitely some history, so before we dive into the numbers, I first want to give you some context of the history.
Yeah, well, I started by explaining a little bit what we do.
Sure.
We're a marketplace for credit. So instead of a marketplace with buyers and sellers, we have borrowers and investors. Borrowers are looking for credit, for affordable credit.
Right.
And investors are interested in putting money to work and earning the yield and taking credit risk on the loans. And LendingClub underwrites, prices, and services the loans. So going into your question about fraud or credit risk, we do a lot of verifications. So when borrowers apply to us, we put a credit report, which is the same thing the banks are doing. We verify income, we verify employment. We connect to a number of data sources that really help us get a good sense of the risk that particular borrower, that particular loan represents for investors. And then we grade the loans and we make all that information available publicly to investors so that they can decide to invest in any particular loan or any particular portfolio of loans.
Okay, well, I'm a big believer in Wells Fargo. My charitable trust has a position. I'd like to think they're fabulous lenders. Do you think that you can do a better job than Wells Fargo?
So I think we have sort of state-of-the-art underwriting capabilities, but I think where we have an advantage over Wells Fargo is in our ability to operate at a lower cost. I think if Wells Fargo were getting started today, they would probably go at it differently than they did over 100 years ago. And so we operate in a way that's fully online. We have no branch network. So we have a lower operating cost than the banks, and we just pass on these cost savings to both borrowers who get lower interest rate and investors who get better returns.
Well, I saw this addressable market that you have in your notes. People who have credit card debt. These are natural people to go to LendingClub, right?
That's right. Yeah. So we like to help people pay off an existing credit card debt and refinance at a lower interest rate. So credit cards are very convenient payment mechanisms, but they're terrible credit instruments. When you charge a credit card, if you carry the balance the next month, you'd be paying 17 or 18% interest rate. We can refinance these balances at an average interest rate of 12% for a 3-year term loan at a fixed rate, which is a more responsible way to manage credit. Fixed rate, amortizing loan, equal monthly payments.
It didn't go that well. In 2016, the company had a big scandal and the shares dropped to an all-time low. The founder and CEO, Renaud Laplanche, was forced to resign. So what actually happened?
So do we know exactly why the CEO is stepping down?
Yeah, so what the company said today is that basically there were $22 million of loans that LendingClub sold to investors that were against what this investor had expressly said they wanted. And the company said they uncovered that in an internal investigation and that was why the CEO had to go.
And what happened to those loans?
Well, they were sold to the investor and the company had to buy them back, and they've since sold them to another different investor.
Now, so what's next? Are regulators expected to step in?
I don't know that regulators are going to step in. I think it's on the company now to basically convince everyone that they have dealt with this internally and that it was a one-off and that it's not a systemic problem for the company.
Right now, before today, were investors concerned about LendingClub's practices?
I mean, I think investors have been a little bit worried about this whole peer-to-peer lending space for some time. Because basically, these companies, they arrange loans to borrowers and they don't hold those loans. They sell those loans to investors. And what we've seen in the last few months is that investors are starting to get nervous and are buying fewer of those loans. So there's a bit of pressure on the whole space now because of that.
The company wanted to turn the tables around. So in February 2020, LendingClub announced acquisition of Radius Bank for 185 million. Radius Bank is a branchless digital banking platform. In October 2020, the company ceased all new loan accounts on their website as part of a restructuring into a new bank. As of December 31, 2020, LendingClub is no longer operating as a peer-to-peer lender anymore. They are leaning into institutional investing, largely because of its higher volume. So what are the advantages of this acquisition? Well, first of all, acquiring the online bank will provide greater regulatory clarity and cheaper funding for its loans. Second, it was also very hard to scale the business through crowd-funded money. The acquisition of Radius Bank was completed in February 2021. The acquisition combines the strengths of two digital innovators with complementary businesses and a digital-first, branchless approach to banking. So being able to hold these deposits, they are basically becoming full circle. The problem LendingClub is solving. Well, many American households have turned to credit cards to manage their finances, which has resulted in 40% of American households carrying $1 trillion of debt, and much of this debt is overpriced, and LendingClub exists to provide Americans with a better way to access affordable credit. While looking at these members, currently they have more than 3.8 million members with an average salary of $100,000 and a FICO score of 700 on average. But they also have a lot of high debt as well. While they are an award-winning member-focused digital marketplace bank with more than 3.8 million customers, as we saw before, they originated more than $68 billion of loans, and the vision is to become America's financial health club. Over the years, LendingClub got a lot of prizes as well, such as the top workplace of 2020, Bankrate's best online bank of 2020. The mission is to empower their members on their path to financial health, and they want to promise that as follows: to champion the financial success of their members with fairness, simplicity and heart. After the acquisition of Radius Bank, LendingClub is well positioned against both the fintech and bank competitive sets. Several examples here, they note the economics, scale and scalability and resilience. What an example of economics is like lower cost of deposit funding, fully integrated originations and deposit model. Focusing on scale and scalability, it's all about this strong growth trajectory, which we will see later, and the vast data advantage that they have from serving millions of personal loan customers. And lastly, the resilience, so that focuses on the stability of the funding, recurring revenue stream, and clear and consistent regulatory framework. The Q3 2021 highlights, LendingClub exceeded all the targets, whether it's originations, revenue, or GAAP net income, while the actuals are as follows. They originated $3.1 billion of loans with a 14% quarter-over-quarter growth, and the commentary is that they leveraged their competitive advantages and data science capabilities to drive existing new member response and conversion rates. While machine learning is one of the big competitive advantages of LendingClub, which saves a lot of money. Looking at the revenues, they generated 246.2 million revenues, up 20% quarter over quarter, and then GAAP net income was 27.2 million. That's up 190% quarter over quarter. LendingClub's growth is driven by accelerating recurring revenue streams combined with marketplace revenues. Well, as of last year, the business is finally taking off again. Last quarter, they had total revenue of 246.2 million. They make a distinction between net interest income and non-interest income. Net interest income is the light blue color, which was 65.3 million, and net interest income reflects the recurring revenue stream driven by the growing consumer portfolio of 39% year over year. Non-interest income is the regular blue color, which was almost 181 million of revenue, and that is driven by marketplace revenue from new loan originations in the period. So where's the growth coming from? Well, origination growth and marketplace revenue is driven by new customer acquisition and data advantages. On the left, they report quarterly loan originations with $3.1 billion of originations split up between marketplace originations of 2.5 billion, the regular blue color, and 636 million of held for investment, the light blue color. This marketplace originations is driving the marketplace revenue, and last quarter they had 175 million of revenue approximately. The interest income from the held for investment portfolio grew 48% quarter over quarter as the consumer loan portfolio momentum builds. On the left they report bank average held for investment balances, and on the right they report bank interest income from held for investment loans. They make a distinction between consumer loans and commercial/PPP loans. The consumer loans represent the light blue color and the regular blue color. is represented by the commercial/PPP loans. Well, PPP stands for Paycheck Protection Program. These are loans that were issued during the COVID period if you had lost your job, for instance, and they carry a lower interest. Looking at profitability in the third quarter of 2021, for the consumer loans, they generated 44.2 million of interest income on an outstanding balance of 1.45 billion. Looking at consumer PPP loans, they generated 13.4 interest income on an outstanding balance of 1.05 billion. Growing the consumer loan portfolio is really driving the yield expansion. I want you to focus on the net interest margin on the bottom right. Over the last 3 quarters, while the first quarter of 2021, they generated a net interest margin of 3.33%. The second quarter it was already 5.5%, and the last quarter it was 7%. Well, if you compare it to an average net interest margin of an American bank in the United States, it's 2.5%. So if you look at LendingClub, they are definitely making a higher return here.
Yes, good afternoon and congratulations on another great quarter. This has done amazing wonders for investors. Couple of questions, and then I'll go back into the queue. You know, if you've got $65 billion worth of originations, 3.8 million in customers, 2.9 billion in deposits, can you start to give us any thoughts about how this all merges together into kind of one neobank? You know, right now you have this great treasury function that can go to the bank whenever it needs assets, and you have this really super profitable bank. But, you know, as these two sides of the equation start to play together, you've got this massive customer base. What preliminary thoughts do you have about getting everybody to work together on a product and revenue front, and what kind of cross-sell opportunities are there between the bank and the club, et cetera?
Yeah, so thanks, Henry. This is Scott. So you are correct. I think what we're showing right now is the core business that we're in, where we've got a leadership role, provides a foundation for an extremely kind of profitable digital bank with a lot of growth just inherent in the model, both the available market outside of us as well as our ability to have revenue and earnings outpace just the sheer loan origination growth. So as you know, Tom touched on a little detail in the script. Our plan is to be taking that net income that we're able to generate and begin investing that into future earnings growth. And the future earnings growth is, first and foremost, continuing to build the loan portfolio, but second, building the customer base, and then third, adding the new products. And the new products you touch on is, we've shared some of the research before, right? I mean, more than half of our customers are already coming back to us for a second loan. So we've really unlocked a great experience there for them. Auto, which we're really now just leaning into, we've pulled it into the bank. The lower cost of capital and the addition of the balance sheet means we've now got positive unit economics that allows us to invest in that business and grow that business. So that's an easy one that we can, you can see us expanding the lifetime value of the customer just through that. And as we pull the purchase finance business into the platform, that is another opportunity for cross-sell, right? We are getting customers today who are the acquisition tack there is actually through providers and not, so the lead-in is not refinancing credit card debt, it's paying for procedures. And once we have them on board, we can do more for them. As we look ahead into next year, you're hearing us lean into credit products. Why? That's the DNA of the company. Our customers are heavy users of credit, so they want and would like to get more from us there. But we also see us, once we get these three businesses, which are businesses we already had coming into the bank acquisition, once we get them into the bank and begin generating the bank benefits off of those businesses, we'll be starting to look at other categories, including helping people manage their spending and their savings, right? Building on the great member rewards checking experience that we got from Radius and leaning into that. And that'll be what we'll probably talk a little bit more about next year. Right now, we're just focused on getting these lending businesses into the bank.
Yeah, traditional banks are facing potentially sizable risks at this moment. So you can think about Wells Fargo, Bank of America, and JP Morgan. Digital wallets are entering the unsecured lending market, suggesting that traditional bank lending is unlikely to recover to the peak hit in 2019. And according to ARK estimates, bank interest income on credit cards fell more than 10%, or roughly 16 billion in 2020, and is likely to drop more than 25% further from 130 billion in 2019 to 95 billion by 2025. And digital lenders such as Square, PayPal, Affirm, Klarna and LendingClub, they are likely to take share from traditional banks. LendingClub clearly has operating leverage, which continues to increase, and also drives further efficiency while investing in a membership growth, and you can really see that on the left. There we have the total non-interest expense as a percentage of revenue, the green line which represents the non-interest expense, and the red line which represents the comp and the benefits is going down over time. You can see that LendingClub is heavily investing into marketing. That's the light blue line, which is going up a little bit because they really are focused on growth, and even more growth. And over time, non-interest expense is going up, of course. With the last quarter, they spent approximately 179 million. LendingClub's vertically integrated marketplace bank model is driving the superior performance. And they also wanted to make a comparison before the COVID period, and they took the fourth quarter of 2019. And what you can see here is that the average originations was approximately the same of 3.1 billion, but that revenue and GAAP net income improved significantly over time after the COVID. And what's the reason for that? Well, they argued this as follows. They had stronger economics on the same volume levels, which was driven by structural advantages of marketplace bank model. LendingClub has significantly lower delinquency rates across the credit cycle. Here they plot the fourth quarter of 2019 prime vintage 30-day delinquency rates from TransUnion data. Well, because of COVID-19, the delinquency rates went up over time, which is very logical. Looking at the industry level, the fintechs underperformed because they had higher delinquency rates, and LendingClub outperformed because they had lower delinquency rates, 50% lower compared to the fintechs. Regarding the credit performance for the next quarter, well, the vintage returns for the loan investors are projected to be approximately 6% unlevered for the Q4 prime vintage. Well, what are the opportunities for LendingClub? First of all, combining Radius and LendingClub will create a digitally native marketplace bank at scale with the power to deliver an integrated customer experience. So on the other hand, consumers pay less on borrowing, and on the other hand, they earn more while saving. In other words, LendingClub is the only full spectrum financial technology fintech marketplace and the first publicly traded US neobank. Looking at the costs, LendingClub is operating at much lower costs compared to traditional banks. Why is that? Because they are basically branchless. Also, LendingClub's investments over time that they made in 2018, 2019 and 2020 are finally paying off and is represented in the stock price. It's not just the decision to acquire a digital bank, but also lowering operating costs and other strategic initiatives in data, technology and digitization, because this is the future. Looking at profitability, LendingClub has a high net interest margin of 7%. Compare that to an average American bank, they get a net interest margin of 2.5%. What is the next goal? Well, according to the conference call, first and foremost, they are continuing to build their loan portfolio. Second, they are wanting to build out the customer base. And third, they want to add new products over time. In the end, this will result in higher revenue and higher profits. And because of wonderful execution, they received multiple price target upgrades after the conference call, varying from 35 to 55 US dollars. So what are the risks for LendingClub? Well, based on the research that I did, I think that LendingClub is back in the game. So the risk that I see for this company is all about execution risks. Are you able to execute according to the growth estimates from the analysts? And maybe from a macro point of view, if there is an economic downturn, people might be less eager to request credit. And also in a downturn, we might see higher delinquency rates. But at this moment, I'm quite optimistic about LendingClub. I would like to thank everyone for watching this video. I really hope you enjoyed it and that you actually learned something, and see you on the next one.